Welcome to this panel that is going to focus on the global financial system and particularly on the role of global uncertainty for global financial stability. I'm very honored to be here with Governor Ayman al-Sayari from the Saudi Central Bank, Pablo Hernandez-Tacos from the BIS, and Jamel Ahmad from the State Bank of Pakistan. To kick off the panel, I'm going to give a very brief introduction. I brought 3 slides to set a little bit of the tone of the panel. So the first point I would like to make is that global financial conditions are very accommodative around the world, particularly for emerging markets. So the left chart here shows you credit spreads across the credit rating spectrum, and you can see they have gotten tighter and tighter and tighter, and that includes investment grade emerging markets, it includes high yield emerging markets and frontier economies. So there's ample debt financing available. Secondly, the middle chart shows you that stock markets globally have rallied, and emerging markets in particular have been a key contributor to this equity market rally globally. What is particularly noteworthy is that profit expectations in emerging markets have continued to outperform expectations. And the right chart shows you that the emerging markets are coming out on top relative to advanced economies and even relative to the tech sector in terms of profit expectations. So a key contributor to this ease of financial conditions is the outstanding performance in terms of profitability. My second slide is about the other side of the coin. With easy financial conditions also comes the risk of growing vulnerabilities. And I'm sure that the panelists are going to talk about that quite a bit. I want to focus on 3 points. The first one is that equity market capitalization relative to the global GDP continues to grow enormously, and there are booms and busts that are recurring. So there's quite a bit of concern among market participants whether the stretched level of valuations in equity markets and in bond markets may come to an abrupt end at some point. Secondly, we see a lot of flows into emerging markets, and for some countries, those could seed instability down the road. Finally, as was mentioned already this morning, there's a nexus between financial stability and fiscal vulnerability. And what is different today to many decades earlier is that the major advanced economies have a notable level of debt to GDP. So the backdrop of global fiscal financial vulnerability is arguably larger than it used to be historically. So the punchline is today, financial market volatility is very compressed. This is measured here by equity implied volatility, the VIX index, which is an index of global risk appetite. You see ample global risk appetite. And that is at odds with a level of global policy uncertainty that remains very elevated. So how is this tension going to resolve? I think the evidence to date is that the ease of financial conditions has fueled economic growth, but there's the vulnerability that we could see a sharp tightening of financial conditions going forward, as we have observed a couple of times in the past year. So with that, let me stop and turn to the panelists, and I'm going to start with Pablo about the global financial system. So how would you characterize today the structural changes in the global financial system? Market structure is changing, the levels of leverage of different players globally is changing, and the notion of financial intermediation is changing. How could that propagate stress in new ways across countries.
Thank you very much, Tobias, and thank you, Minister. Thank you, Kristalina. It's a pleasure to be here in this wonderful country and wonderful place. I will try to focus on one of the aspects that you've stressed, Tobias, which is also related to two structural changes that we have seen in the financial markets after the global financial crisis, which are mainly, yes, debt has increased, but the increase in debt has mainly focused in the public sector. So the weight of public debt over total debt today is much higher than it was before the global financial crisis. And then the second is something that was also stressed by Governor Bailey this morning, is the increasing presence of non-bank financial intermediation. And the interesting thing is that these two factors are interrelated. I will claim that there are some positive elements derived from this, from the financial stability perspective, but at the same time there are also some risks. Of course, they are related because non-bank financial intermediation is now playing a larger role in the intermediation of public debt. And maybe it's interesting here to distinguish two main players. On the one hand, what I would call real money players, which are pension funds, insurers, that we know, of course, now they have significant holdings of public debt. The good thing is this is mainly long-term debt, and also that the degree of leverage is low. Second, of course, we have other players which are mainly hedge funds, which are highly leveraged. Okay? In any case, both and the interaction between these two segments could increase financial stability risks. On the one hand, if you focus on the real money players, it is true that they are long run and also non-leverage, but at the same time, we also know that they are mainly players of the international dimension, and this basically means that they need to hedge, and they hedge precisely in the FX swap market, and this is FX swap market. We know how significantly it has increased its volume during the last, since the global financial crisis again. In the case of the hedge funds, well, we know what the presence in this public debt management. They are in a market on which the margins are very, very low. So in order to make profits, they need high volumes. And of course, these high volumes come from also high leverage, in particular in the repo market. And of course, these two markets, the repo market and the FX swap market, are interrelated. And it adds an additional channel of potential amplification for the future, is that we know is that it is the dealer banks, the ones who are the providers of, in particular, dollar funding in these markets. So I would claim that, of course, a potential disruption in this market could, in the end, spread through the repo market and ultimately on the FX swap market, and this could be a potential amplification channel for financial stability, materialization of risk. So you could ask me, Tobias, well, what do we do with this? Well, we are trying to, in particular at the FSB table, well, the focus on MBFI regulation has been already there for a while, and of course, the point I want to stress here today is that we need to continue with this work. And of course, in parallel, the fiscal situation in many countries, by the way, more importantly today in developed countries as well, of course, we need also fiscal consolidation to be a key priority, as it was also mentioned in some of the speeches this morning. Thank you.
Thanks so much, Pablo. And yes, the banks are safer, but some of the activity has moved to the non-banks, and that could be a transmission channel for countries around the world, including emerging markets. So let me turn to Jamil Ahmad, Governor from Pakistan. So how do you see, from an emerging market perspective, the potential transmission channel of these global disturbances into your country, and how is this different today relative to earlier stress periods?
So thank you very much, Tabians. First of all, let me thank the Minister Al-Jidan, Excellency Minister Al-Jidan, and the Managing Director of IMF, and also Sama Governor for inviting me. And I'm sure this is going to be a very successful event and very well attended, followed by the last year's successful event. Coming to the question, I will say that the change this time in transitioning of those uncertainties to the emerging markets is the foremost visible change which we have seen is the elevated global interest rates and their impact on the emerging economies. But we can say that the interest rates in the past have also been elevated. But the difference this time is that they are higher for a relatively prolonged period, and also are impacting countries, particularly countries like us, much more intensively as compared to what we have seen in the past. And there are various reasons for that. Although the emerging market economies have been facing economic imbalances in the past also, they have been facing higher inflation, higher current account deficits, higher external debt, and also higher fiscal deficits also. But the difference this time is that the intensity of those shocks is much severe. The impact of global uncertainties on these macro balances is much severe. And also the transition has taken place much faster. So because of maybe the reason that the global uncertainties and stresses are taking at a much more frequent level, and also the intensity is also relatively on higher side. So, so that's the reason we have been facing the impact much more sharper as compared to the past. But I will say the response from the emerging markets is also this time relatively, initially not very proactive, but over a period of time we have learned a number of lessons from our experience. And I will say now for instance, in our case, we have learned that the importance of more proactive monetary policy. And as a result of that, also the transmission of the monetary stance to the local markets and to stakeholders. And at the same time, also we have learned the importance of building up buffers, particularly the foreign exchange buffers, because if we are able to do that in the period of calmness, then we are able to withstand shocks much more effectively. But if we are unable to do that, then it may not be leading us to adequately cope with the situation. And the second question was about stresses. I think the impact we have seen, the much more severe impact on the external account, because that's the first one which is impacted, and that is impacted not just the global interest rate channels, but also ultimately to the domestic interest rates and price escalation, inflation increasing to an alarming high, historic high level, and also significant depreciation of exchange rate. And as a result of that, then it's transitioning to the fiscal account also. And as a result of that, the government also has to take a number of measures to address their fiscal imbalances. So I think I will say overall, the transition was sharp and the impact was intensified, but at the same time, the response which we have been able to provide over a period of time has also taught us many lessons, and ultimately we have been able to deal with those severe shocks.
Yeah, this nexus between fiscal policy and monetary policy has really come into focus in recent years in many countries around the world. And as you mentioned, the magnitude of shocks is so much larger. So that's a challenge, certainly for many countries. Let me turn to Governor Al-Sayari. Ayman, thank you for hosting us here in Saudi Arabia. So let me ask you, what is your perspective on the global financial system? How do you see global vulnerabilities? And from the perspective of resilient emerging markets that have ample buffers, how do you see this changing environment impacting your policy frameworks?
So thank you. And before I go to your question, if you allow me first to thank you, Tobias, for being here and moderating our session. And I'm also honored to be on this panel with distinguished speakers, Pablo Hernandez of the BIS and Jamil Ahmed of the State Bank of Pakistan. Both are good friends and we have interacted with personally for many, many years. And of course, I will echo His Excellency Jalan welcoming everyone to this lovely city of Al Ula and the Kingdom of Saudi Arabia. So taking a step back, before going into emerging markets and resilience versus perhaps what could be labeled as more fragile ones, let's talk about global uncertainty that we're facing today, which is altering the way we are operating in and today. And that is, in my opinion, created an uncertainty that is tilting more towards being structural rather than episodic. And I'll cite 4 reasons for that. First, geopolitical fragmentation. And secondly, obviously, and continues to be the rapid technological advancements. And there are a lot of unknowns that we will be discovering in the coming months and years, especially as it relates to AI and how this will disrupt the financial system transmission of intermediation as we know it. And third, which is perhaps more pronounced, I mean, also to advanced, but also to emerging on commodity prices for both exporting as well as importing economies. And lastly, the one that Pablo also mentioned on the growth of non-bank financial intermediation, MBF, or what's known as MBFIs. And here, I will cite a few points to that matter. So the way the traditional transmission mechanism works, and here I'm talking about interest rate especially, has started to feel cracks or weakening over time, because normally it's done through the traditional banking system. And this has perhaps made such transmission less linear and less predictable. The growth of MBFI now has eclipsed in terms of size, the banking system. And now, as data cited by both your institutions, the IMF and BI, shows that it has already surpassed 51%. And what does that mean? That means of global financial asset. It means that market sensitivity to political signals has started to weaken. And that has caused more episodes of liquidity stresses, as we have seen over the past few years. And this is propagating through market mechanisms. An example like margin calls, collateral haircuts, as well as synchronized deleveraging. Shocks to the global financial systems are increasingly multidimensional in nature. And what I mean by that, that they occur with higher frequency and largely exogenous to domestic fundamentals. From an emerging market perspective, especially that emerging economies already face certain challenges as they grapple with greater economic volatility and are frequently tested by local or endogenous factors that is inherently there, as well as exogenous factors that amplify certain volatility. So emerging markets inherently have both structural and institutional vulnerabilities that amplify exposure to changes in the global financial conditions. This is, in my opinion, largely attributable to the limited ability to absorb shocks and mitigate volatility. Geopolitical tensions, trade fragmentation, and also elevated debt levels as well as costs are therefore most consequential challenges that we as emerging market policymakers face today. The persistent trade tension could lead to increase or acceleration in inflationary pressures, dampen export revenues, weaken future growth prospects, which in turn weigh down on investor sentiment, and that creates, of course, volatility in capital flow. Therefore, that complicates the policy environment. To your point about resilient versus less resilient or fragile economies, I would cite two key differentiating characteristics between the two. First, the presence of coherent domestic policy frameworks, and here I mean monetary, fiscal, and financial, which supports counter-cyclical responses that mitigate capital flow volatility without amplifying domestic financial cycles. Second, creation of effective shock absorbers. And here, I cannot stress enough the need for an adequate level of foreign exchange reserves. And equally important, greater financial market depth. And here, we're talking about debt capital market and money market funds that support as diversifying the structure of the funding base in the emerging economies. So these are differentiating factors for resilience vis-a-vis non-resilient or fragile economies. Let me take a perspective of the Kingdom of Saudi Arabia. So what we have done, as known, we have employed reserve buffers to preserve financial and monetary stability. We have also demonstrated criticality of counter-cyclical policies to smooth economic cycle. As you know, we rely a lot on oil receipts, and the accumulation of reserves during economic growth is only used to support balance of payment needs strategically to help, I would say, smoothen the economic activity and economic growth and support the growth and insulating it from the changes in the volatile commodity. Our exchange rate stability, which revolves around anchoring the rial to the US dollar, which has served us well over the past 4 decades, helped preserve policy stability, price stability in the Kingdom of Saudi Arabia. And I'll cite one anecdote here. If we look at the last 5 years of inflation, year on year, it has been below the 3% level. For an emerging economy, I think that is quite modest, and it has been a key contributor to continued financial stability.
All right, so let me just share that in our discussions at the IMF, we often point out that the resilience of the major emerging markets over the past 5 or 6 years has been tremendously impressive. I think the factors that you're pointing out, more reserves, more resilient institutions, better policy frameworks, are really the key contributor that has caused this stability of the major emerging markets. It's quite different from 20 or 30 years ago, and I think it's a first-order shift. Before turning to the second round of questions, let me point out to the audience that you can ask questions as well. There's a QR code that is going to be shown online, and after the next round, I'm happy to take the questions from you on board. So let me turn back to Jamil to ask a second round of questions. So this is really about institutional credibility and institutional frameworks for the central bank. Central banks around the world have to manage inflation, manage financial stability, and external volatility, as you already pointed out. So can you give us a little bit of a flavor of how central banks can navigate the political environment when, sometimes their credibility may be questioned, and how do you continue to be an anchor of stability and credibility in this challenging environment?
Thank you very much. I think, first of all, for establishing the credibility, the institutional capacity of the central bank to respond to shocks. We have to build up the capacity. I mean, we will have to also clearly define the mandate of the state bank or any other central bank. So if we are clear in what we want to do, where we want to go, then all actions should be focused on achieving the ultimate goal, which has been clearly defined. And for that, I will also say the independence of the central bank, because it has to take decisions sometimes which may not necessarily be aligned with the government policy matters. So, so that clarity of objective and then actions to achieve those objectives, and while taking actions to be independent of other political economy. So that's important. Secondly, I will say the credibility will come when if the central bank has defined the price stability as the core objective. So all its efforts will be focused on achieving the core objective. But for that, it will also have to have anchored inflation expectations. So if the central bank is taking action, but the market is not believing in those actions, and they think that we are not doing enough to achieve our core objective, so there will always be divergence, and there will be a credibility gap. So that's the reason the actions of the central bank should be proactive, timely, and much effective in order to enable it to achieve the ultimate objective. And also, I think the most difficult part is when the central bank try to take some of the actions which are preemptive in nature. Although, for instance, in our case, the recently for few months, the inflation is much on lower side, within the central bank range. In fact, for many months below the central bank target of 5 to 7%. Now, if we are keeping the interest rates which are at a much higher level, and there is a high real effective interest rate, so the question will come, why we are keeping so much high interest rate and we are not supporting the growth and businesses. But many stakeholders will not know that what is going to come, because there are many anticipated global developments and also local developments which may impact inflation. And ultimately, this high real interest rate, which looks to be high now, may not be there down the line, some months down the line. So, so that's the reason for the central bank, it is quite difficult sometimes to convince the stakeholders, particularly the economic agents, to buy in the idea that we are keeping interest rate high because of the reason that something is going to come, and ultimately we will have to deal with that situation. And if the central bank is able to communicate effectively and is able to get the economic agents on board in the stance of the monetary policy, then I think the credibility will not be disturbed. But if we are unable to do that, then there will be a credibility gap, and that's the reason, and this is what we have seen 2 to 3 years back, for a prolonged period of time, almost one and a half year. At that time, the market was not believing what we were seeing. And I clearly recall one instance when in one of the speech I said that our inflation will come down within 5 to 7% range. And at that time, the actual inflation was in 30+%. It went high, historic high at 38%. And we were talking about 5 to 7% range. So obviously, there was a huge gap. And when I said in one of the speeches, it will be 5 to 7%, so some of the large private bank CEOs said in a private meeting that as if I have missed one. I wanted to talk 15 to 17%, but I said 5 to 7%. This is what I said. Even well-informed professional people were not believing that we will be able to achieve 5 to 7%. And now, 1.5 years down the road, for the last 1 year, we are within the range of 5 to 7%. Similarly, our reserves, which went down to less than $3 billion, And our current account deficit, which went high in 2022 to 4.7% of GDP, gradually came down, and last year we were in surplus 0.5% of GDP. And this year also so far is very well contained. And our results has increased 5 times from less than $3 billion to more than $16 billion. So I think this is the actual real implementation of the policies. What we said have actually implemented, and as a result of that, the credibility is restored. And the market now, and look at any analyst which is forecasting, I mean, look at the Reuters, Bloomberg, any other good reporting media agency, and look at the professional analysts. All of them are saying inflation will stay for this year within 5 to 7%, for next year within 5 to 7%. So this is the credibility, that what we are saying, market is believing in that. So if this is not there, then there will always be divergence and will not be able to effectively implement the monetary policy stance. So that's what.
I think that's a great illustration of what it means to gain credibility, and also an illustration of how tough it is to be a central banker, because you need to take decisions that may not be popular in the current moment, but ultimately are beneficial to the economy in the long run. So that's a great illustration. So Pablo, let me also turn to regulatory frameworks as well as the central banking frameworks. Credibility, as we just heard, is foundational. The clarity of mandates is absolutely foundational, and of course, consistency of regulatory approaches. So how do you see sort of like the role of this institutional strength in terms of building market confidence, containing systemic risk, but then also having broader traction with other policymakers and with the general public?
Well, in the case of financial stability, I think we should start by stressing something that was also stressed by Governor Bailey this morning, is that yes, financial stability is a public good, and therefore we need good institutions to deliver at the domestic level. But, and here is the nuance, an important nuance, is that it's a global public good. The degree of interrelations in the financial market are so significant that we know that the domestic policies that are not fully coordinated are not going to work, are not going to deliver in the objective of financial stability. And this is why having, as a first element of confidence, global standards is absolutely critical. And again, I fully agree with Governor Bailey that there are no second best here. So we have to start building the house with these global standards, definition of the global standards, which of course also requires global surveillance of the different risk and adoption of standards that mitigate the risk that we are able to identify, and then of course critically implementing those standards once they have been set. So that's the first element I want to stress. Then when you move to the national frameworks on financial stability, yes, we've been emphasizing, and for very good reasons, on the monetary policy front, how important is to have an independent central bank with a clear mandate, and of course with full accountability. I think the arguments that we've been using for many years already in order to justify such a framework, I think are fully applicable also to the financial stability domain. So the supervisors, the macroprudential authorities at the national level also require, again for the same reasons, to be independent and to have clear mandates. Very important to have adequate resourcing, of course, in order to deliver. And it is the combination of these two elements that is absolutely critical. And also to have this international dimension with the international standards that provides the markets and of course our citizens with confidence that there is an adequate framework in order to guarantee financial stability, but then at the national level also that there are institutions that take care of the supervision of the financial sector, and that therefore are able to implement on a day-to-day basis. So this emphasis on strong institutions for supervision of the financial sector at the national level, I think is also absolutely critical, of course, together with these multilateral agreements on the global standards that are needed on this domain.
Yeah, let me just add here. I have the great pleasure of working closely with Pablo and Ayman in the Financial Stability Board. That is really the umbrella for the standard-setting bodies to get to this regulatory consistency. So Ayman, let me turn to you and continue with this theme of global cooperation. We have heard many comments this morning underlining that the geopolitical fragmentation is making international cooperation more important, and of course Saudi Arabia plays a key role in that. So how do you see how international cooperation is evolving in terms of financial stability, in terms of central banking? And perhaps if you could also give us a perspective on the role of the dollar and sort of like the international monetary system. How do you see that evolve, and how is that sort of like interrelated with this theme of international coordination?
Sure. So I think Pablo has pretty much covered in great deal the financial stability and importance of it, and obviously this is a shared goal among developed and emerging economies alike, and that requires, of course, strengthening the international cooperation to help take us in a. I would say we will always face new emerging areas of vulnerabilities, but how to be proactive and how to deal with them is quite important. So these points cannot be overstated. But let me also acknowledge and give credit when credit is due that remarkable progress has already been made by policymakers across the globe. And I also a proponent of a shared learnings among policymakers, which helps us in having a better informed and more vigilant and responsive regulatory stance across emerging markets specifically, and that which contributes in turn to global stability. The policy toolkit has continued to evolve. I mean, we don't have to go back to the GFC and what happened afterwards, and the pandemic, and then what has changed. And even recently, you mentioned trade fragmentation, supply chain disruption. There's a lot on our plate that we need to focus on and work in the coming months and years, and we need to adapt to this, notwithstanding other risk factors like rapid technological changes. So to the point about the de-dollarization, I would coin it differently in a way. So rather than talking about de-dollarization, I would focus about this new, I would say, term that's been used is better understood, in my opinion, as a gradual reconfiguration and routine diversification within a resilient monetary system that is anchored in trust, a robust institution, and an effective cross-border coordination. The dollar, as a matter of fact, continues to dominate invoicing, payments, intermediation, and reserve holdings. The latter constitute today 57% of global foreign exchange reserves. And when you talk about 70 FX transactions, 89% has one leg, that is the US dollar. So these are facts. And these data are as of late of 2025. So, and also the discussion about the decline or depreciation of the dollar over the last few years, we need to look at it in a different context. We need to take a longer observation window and look at the dollar, how they behaved over different cycles, from ditching the gold standards back in the early 70s all the way now. it remains within its cycle range, and it's still above its 50-year average. So rather than that, we just focus on how to get the most out of it. I believe with its enduring structural advantages, here the U.S., unparalleled market depth, liquidity, and robust legal foundation. Of course, there are hiccups along the way, but I'm talking longer term. I take a long-term view. I believe it will likely remain a central point to the international monetary system, at least for the foreseeable future. But also, I would like to speak about international collaboration. And there are three vital points I would like to perhaps conclude with. The first, rapid growth in payments, innovation, and non-bank financial intermediation spills across traditional jurisdictional perimeters. We need to redouble our cross-border data enhancement efforts to enable effective surveillance and vulnerability assessment. Second, we need to strive to achieve greater harmonization and interoperability in a prudent adoption and oversight of emerging technologies. And this is to ensure sustainable innovation without, again, jeopardizing financial stability. Financial stability, I think, comes first. And last, and perhaps most importantly to emerging market economies, is that we need to accelerate collectively knowledge sharing to advance regulatory and supervisory modernization efforts across jurisdictions. And just to conclude with this point, in an interconnected global financial ecosystem, our collective resilience is only as strong as our weakest link.
That's a very good point to end this discussion. I think we had a very, very rich discussion here, and we are running out of time. We covered global financial stability, institutional resilience, regulatory issues, and of course, global cooperation. So hopefully this was a good panel for you. Thank you so much, and thank you so much for the panelists.
Thank you.